begin. So my name is Jacob Goldman. I'm the Vice President of Energy Tax Savers. Some of you might have heard of the Inflation Reduction Act, and we're going to cover two of the main parts of the Inflation Reduction Act, and then a couple other concepts. There's all these alternative energy tax credits that came out, and we'll talk about how you qualify for those. Kind of a non-Inflation Reduction Act part is we're going to talk about depreciation, something called 5-year makers and bonus depreciation, and then the concept of time value of money. We'll then talk about another Inflation Reduction Act incentive called 179D, which is a tax deduction for putting in energy efficiency in buildings. And then throughout the presentation, you'll see why it's clear that we need to talk to you about prevailing wage and apprenticeship. And so we're going to touch on at the end prevailing wage and apprenticeship. And to the extent somebody has a question, don't hesitate to ask it while the slide's up. That's kind of the best time. If it gets maybe too many questions for time purposes, I'll just carry forward a little bit, but glad to answer questions as I go along. By the way, there's a lot of technical citations, web addresses in the presentation. If you would grab your phone and take a picture of my email address, jacob.goldman@energytaxsavers.com, I'd be glad to send you a copy of these slides. So jacob.goldman, it's on every slide. I have my email address. So if you want a copy of these slides and want to see all the citations and want to see the websites that I present, don't hesitate to shoot me an email. I'd be glad to send you a copy of these slides. So what you're looking on the screen now is a laundry list of tax credits that are available for, you know, some created by the Inflation Reduction Act, some of them pre-existing and then just adjusted because of the Inflation Reduction Act. Some of you might be familiar with like the solar tax credit. On a historical basis, it was a 30% credit. The Inflation Reduction Act reduces the credit actually. It actually drops it down to 6%. And it does that. Ground source heat pump used to have a 10% credit. The base credit is now 6%. CHP had a 10% credit. The base credit is now 6%. Thermal storage had no credit, and now starting in 2023, we'll have that 6%. But the way this incentive works is it has all these different bonuses. So if you qualify for all the bonuses, you know, solar could max out at its 70% credit. Some of the other technologies max out at a 50% credit. And the reason I have ground source heat pump, CHP, and thermal storage in bold, they're the only technologies that qualify for both these Inflation Reduction Act tax credits, but they also qualify for the 179D tax deduction typically. So you can kind of double dip. So the key here is how do you qualify for all the bonuses? You know, there's so many different bonuses. Sometimes I feel like I'm on an infomercial and I'm going, but wait, there's more. You know, there's all these different ways to qualify for this thing. And so we're going to go over some of those. But it's amazing. You know, ground source heat pump used to have a 10% credit. We've already seen examples where the project is going to get a 50% credit because it's in the right location, using the right equipment. So basically, it's a half-off sale for that ground source heat pump project. Unbelievable compared to what we used to have, which was a 10% credit. Before we get into the bonuses, though, there are some very interesting goodies in the Inflation Reduction Act. And the first one I want to point out is this section 6417. For the first time ever, not-for-profits are going to be able to directly get a tax credit. And not only not-for-profits, but state and local governments will also directly get a tax credit. So you might have seen like solar projects on a public school, but oftentimes those are set up as a PPA where a commercial entity owns the solar and then sells the energy back to the school. schools won't need to do that anymore. They'll be able to buy their own solar project, and then they're going to get directly a tax credit. That doesn't work on the federal side, so federal projects don't qualify, but state and local and not-for-profits, starting in projects placed in service in 2023, they're going to directly get a tax credit. And when I say directly get a tax credit, they're going to get all these, any one of these tax credits that they qualify for, they're going to get them. We just talked with a school district, you know, they didn't know anything about this legislation. They did a solar project where from the utility, they got the connection agreement on January 16th. They're going to back into a 30% credit for their project. It was like a, you know, I think it was like a $2 million project. They're going to get $600,000 that they had no idea that they were going to get just by putting solar on their building and placing it in service in 2023. So it's incredible legislation where state and local governments and not-for-profits now will directly be able to get these tax credits, and that's because of Section 6417. There are some haircuts potentially. This haircut right here really starts after 1/1/24. So if you place something in service in 24 and beyond, then there could be a 10% haircut. But there's no haircut if your project's less than 100 megawatts, and there's no haircut as an alternative if you meet the domestic content requirement. But if you don't meet the 100, if you're more than 100 megawatts, or you're more than, you don't use domestic content, then starting in 2024, you get a 10% haircut. The other haircut is if you use tax-exempt bonds. There's a calculation for the haircut, but it maxes out at a 15% haircut. They cut the credit by 15%. So on the commercial side, oftentimes there's types of entities that cannot take a tax credit because they don't have tax liability. So this section 6418, allows those companies, and this is only for tax-paying entities, not for not-for-profits, not for government. This is only for tax-paying entities. But if you can't take advantage of the tax credit, 6418 allows you to sell it to somebody that can take advantage of it. So all these credits, if you can't take advantage of it on your tax return, you can go ahead and sell it to another party and they can take that credit. Now, you're not going to be able to sell it for if you have a $1 credit, you're not going to be able to sell it for $1. There'd be no reason for somebody to buy that. But you might be able to sell it for 80 cents on the dollar, maybe even 90 cents on the dollar. And so you're going to be able to sell your credits if you're a commercial building owner, if you can't use them. Otherwise, you can use them directly. So let's talk about some of these bonuses. So the first one's the 5-time bonus. So it's a 6%, as I mentioned back here, it's a 6% base credit. To get the 5-time bonus, 6 times 5 gets you to 30%. There's 3 different ways you can qualify. So the first way is like that school district that I talked to you about. They started their project before January 29, 2023. If you start your project before this date, then you're grandfathered into the 5-time bonus. So it doesn't matter how big it is. It doesn't matter if you use prevailing wage and apprenticeship. If you start the project before January 29th of 2023, then you automatically get the 5-time bonus. The other 2 ways to get the 5-time bonus, one is you're a small project. And they express that in megawatts. So if you put in less than 1 megawatt, you qualify for the 5-time bonus. Ground source heat pump is typically not measured in megawatts. So we've translated that to 284 tons. There's an industry group in the ground source heat pump world that is using some mathematics to say, no, it shouldn't be 284. It should actually be 444. But we don't know if IRS is going to accept that or not. I would feel very comfortable on any project under 284 tons for it to get the 5-time bonus, and then it's a little bit of a question mark after that. If you're bigger than 1 megawatt or bigger than 284 tons, then the project needs to meet prevailing wage and apprenticeship requirements. You need to meet both of them. And I point you to some rules that did come out about a month ago, IRS Notice 22-61. And don't hesitate to take a picture and shoot me an email, and I gladly send you all these slides, jacob.goldman@energytaxsavers.com, and you get all that information. But I mentioned that this presentation will touch on prevailing wage and apprenticeship at the end of the presentation, because there's multiple different incentives that require or sometimes require it. So the 3 ways to get the 5-time bonus is be a small project, be under a megawatt, meet the prevailing wage and apprenticeship requirement if you're a big project, or did you start your project before January 29th, a couple weeks ago? Did the project start? If you started before January 29th, then you're going to back into the 5-time bonus automatically. And so here we go with the wait, there's more. We now have another bonus. It's called the domestic content bonus. It only starts for projects placed in service in 2023. And it says that if your project has 40% of the cost of steel, iron, or manufactured product is produced in the US, you get the bonus. Now, the bonus is really a 2% bonus. So 6% goes to 8%. But if you meet the 5-time bonus, you get to multiply the 2 by 5 as well. And so you automatically get 10%. So what I would tell you is that solar traditionally is manufactured in Asia. There are some US manufacturers, but a lot of it is manufactured in Asia. So it might be difficult to get the domestic content bonus for your solar project. But ground source heat pump, a lot of ground source heat pump is manufactured here in the United States. CHP, a lot is manufactured here in the United States. Thermal storage, a lot is manufactured here in the United States. So if you are doing one of these technologies and you meet the 5-time bonus, it's pretty straightforward to get up to a 40% credit for these technologies. So where thermal storage used to be sold with a 0% credit, imagine how much thermal storage will be sold at a 40% credit. CHP used to be sold with a 10% credit. Now you could get 40% credit if you meet the 5-time bonus requirement. So tremendously valuable for those industries that are designed where they're manufactured here in the United States, because you get this extra 2%, or if you meet the 5-time bonus, the extra 10%. The next bonus, once again, wait, there's more, is a 2% bonus again, but if you meet the 5-time bonus, it turns into a 10% bonus. And so there's 5 different ways for something to be considered an energy community. The first one is that your project is in a census tract or adjoining census tract where a coal mine was closed in 2000. I kind of call that the Joe Manchin bonus, because Joe Manchin from West Virginia, lots of closed coal mines in West Virginia. So almost the entire state of West Virginia is an energy community. The next way to qualify as an energy community is if your census tract or adjoining census tract had a coal-fired plant that was closed since 2010. That's kind of strewn all throughout the United States. If you did your project on a brownfield site, you get the energy community bonus. These other ones are a little harder to calculate. An area with 0.17% direct employment from coal, oil, or natural gas, and that same area has higher than average unemployment, or an area where 25% of the tax revenue comes from coal, oil, natural gas, and higher than average unemployment. Now, good news is we got word on another incentive that it looks like IRS and DOE are going to be providing maps. So you're going to be able to go onto a DOE website and get a map for what actually qualifies. Now, there's some other organizations that have come up with maps. Now, I can't vouch for their accuracy, but I have tested a couple different projects and they did match. And some of those files are, the websites are right here, but I did call them up so you can take a look here. This is the energy community in and around Huntsville. So you'll see that Huntsville itself does not have an energy community, but adjacent locations are considered energy community. And more than likely, it was because some coal plant closed since 2010. So if you're doing a project in one of these blue areas, that project qualifies for the bonus for that. So unfortunately, not an energy community right in the Huntsville area, but outside of Huntsville, in surrounding areas, you can qualify for the energy community bonus. So we just got guidance yesterday. So this is a brand new slide, just so you're aware. You can tell your Central Alabama colleagues that they didn't see this slide because this is brand new just for you. You're the first people I'm presenting this to. And that's because yesterday IRS Notice 2023-17 came out. And this is specifically for low income and specifically for solar and wind only. You might remember on this chart that most technologies max out at 50%, solar and wind can get all the way up to 70%. And that's because of the low income bonus. And it's only available for solar and wind. But one thing I did learn yesterday is that if you're putting in battery backup that is connected to the solar and wind, the battery also qualifies. So that was a piece of new information that we found out in the notice that came out yesterday. This, unlike the other bonuses and credits that we talked about, those other ones you just file on your tax return. These you have to apply for and get allocated. So there's going to be a pre-application period. They're only going to give it out for 1.8 gigawatts of direct current each year. There's going to be a 60-day application window, and obviously, typical to a lot of this stuff, we don't have much guidance on the application. What we do know is there's 4 different categories that qualify, and their allotment of the 1.8 gigawatts is this. So if you're in a low-income community, it's a 700 megawatt allocation of the 1.8. If you're located on Indian land, it's a 200 megawatt allocation. Something called a qualified low-income residential, 200 megawatts, qualified low-income economic benefit is 700 megawatt. The credit is 10% for these 2 categories and 20% for these 2. And the applications are going to open up in the 3rd quarter, and then these applications are going to open up sometime after that. So what you're going to want to do if you're in the solar game is you're going to want to find projects that qualify for these 2 residential-based project categories, and you can't do the project ahead of time. You have to get pre-approval. So you're going to want to submit your projects, proposed projects, get the allocation, and then you have 4 years to complete the project. So sometime in the 3rd quarter is when you should be applying for these projects, and obviously we're going to get more information as time goes on. And you'll apply for them, and you'll kind of, it'll be a little bit like a lottery. It could potentially be first come, first serve, but more than likely it'll be oversubscribed, and in which case they're probably going to do like allocation of it. So you won't get the full credit, you'll get some sort of ratio of it. Here's the definitions for all those different categories. So the first one is basically you have to be located in a low-income community. There's a map for that, and I'll show you that map in a second. That means your census tract, the poverty rate is greater than 20% in your census tract of your project. Alternatively, if you're in a non-metro area, the census tract's median family income is less than 80% of the rest of the state. Or if you're in a metro area, then it's less than 80% of the state or 80% of the metro area. And so I'll show you that map, what that looks like. This is what it looks like in and around Huntsville. Now, once again, I don't vouch for this slide. IRS is going to come out with actual maps, but this is in and around Huntsville right now. These are places that are low income. So if you do a project, if you have a project in one of these areas, you can submit for that pre-application. Was there a question?
No, our screen's blacked out for a second, so I thought we went into screensaver.
Okay. So if you're in and around this area, if you do your project here, you can apply for an additional 10% credit for the low income community. If your project is located on Indian land, you can apply for that. That's all defined at this United States Code 35012. To get the bigger credits, the 20% ones, where you're going to be able to apply for it in a 60-day window in the third quarter, it has to be a this one, qualified low-income residential building, has to be a residential rental participating in affordable housing program. These are the 3 affordable housing programs that qualify. Covered housing, which is defined by this section in code, Ag Department housing assistance, which is defined by this code, and tribal designated housing, was defined by this code. And the electricity has to be allocated equitably among the occupants of the residential building. So that's how you get the 20% credit. Another way to get the 20% credit is if you're in a qualified low-income economic benefit project. And basically, that's where you're providing electricity to households with income less than 200% of the poverty line, or incomes at 80% of the area's medium income. So if your building is provided to households in these 2 categories, then you can get the 20% credit. But once again, you have to apply for these, and the application is going to open up in the third quarter, and that application window is going to be 60 days, and it's going to be limited on an annual basis to these allotments. So you can't do your project already. You have to, this is pre-project. You have to apply for this to get these, and it's completely additive. So it definitely adds to all these other incentives to potentially get you for small wind and solar all the way up to the 70% credit level. So 70% off on a solar project is a lot of discount for a solar project. Now, the key is for that low income one that you have to pre-apply. There's an application process. It's not automatic. These ones are automatic. You just file it on your tax return and you get these credits, or you file it on the documents, whatever documents IRS comes up with for your state and local and for your not-for-profit. So there'll be some sort of documentation that comes up. Any questions on these credits? So going to touch on some of the key technologies, the ones that qualify for both. So ground source heat pump, once again, it's a 6% base credit. What typically qualifies is the bore field and the heat pump. So that's a definite. It's the equipment, the installation, and the design qualifies. For anything downstream of the heat pump, meaning your duct work, your diffusers, any sort of heat exchangers or piping and pumps, there's a tax interpretation we have, and that's this section code right here. At least 75% of the energy used by the equipment must be from the ground. So what that means is if, for example, your building has a backup boiler using gas, on an annual basis, the ductwork that is feeding the air has to get more than 75% of its energy from the ground and less than 25% of its energy from that backup boiler on an annual energy basis. If that's the case, you get to take that ductwork, the design of it, the installation of it, and the equipment, you get to take that as part of the credit up to the amount of percentage fed by the ground. The other aspect that's interesting for ground source heat pump is ground source heat pump has good legislation all the way out to 1135. All the other technologies peter out at 1125 and then switch over to another incentive or disappear altogether. So construction must begin for ground source heat pump by 1135 to get these incentives. Thermal storage. There's a couple different rules here. It has to be directly connected to a heating, ventilation, or air conditioning system. It has to remove heat from or add heat to a storage medium for subsequent use. And it has to provide energy for the heating or cooling of the interior of a residential or commercial building. That's a key one there. If you're heating and cooling a process, it doesn't qualify. You have to be heating or cooling a building. Doesn't include swimming pools, CHP, or buildings or their structure. And construction must begin before 1/1/25 for this to qualify. So we basically have 2 years to start construction this year and next to get this thermal energy storage. Last one I'll point out here is CHP. Interesting parts is if you're bigger than 50 megawatts, no tax credit at all. No tax credit. If you're bigger than 15 megawatts, there's a haircut, and it's based on how many megawatts you have compared to 15 divided by yours. So if you have 30 megawatts, you cut half of the credit out. If you're lower than 15 megawatts, then you get the full credit. Couple different rules. The energy efficiency has to exceed 60%. 20% of useful energy, at least 20% of the useful energy has to come from thermal, and at least 20% has to come from electrical or mechanical. And it doesn't include anything that brings the gas, for example, to the unit or bring the electricity or steam from the unit. So it's really just that central portion of it. It's the turbine and the boiler and any heat exchangers. That's it. It's the design, it's the equipment, and the install. Things that bring energy to it and from it don't qualify. Any questions on credits? Because we're going to move on to a completely different topic, kind of. I see somebody raising their hand.
So I know a lot of these programs for the IRA are split between federal and state level in terms of who is responsible for divvying up the money and handling the applications and things like that. Do you have any insight, like all the ones that you've spoken about so far, are all of those federal programs or state programs or a mix?
Yeah, so everything I'm talking about today is federal related, and directly you'll be filing something with the federal government. Most of the time it's filed just with your tax return, although for state and local, they don't file a tax return, so they're going to have to create some other form to file with Treasury. The low income one, that's going to be filed with Department of Energy. But it is all going to be federal. None of these are part of those programs that you're talking about where they allocated funds to states and the states are going to come up with programs to divvy them out. These are all federal incentives, and you directly file most of them. The tax credit, for example, most of it is filed, with your tax return. And only in some cases is there an application with DOE. Did that answer your question?
Yes, thank you.
Okay. So this is not a part of the Inflation Reduction Act. I'm just going to talk a little bit about depreciation. So everything I just talked about, all those different technologies on this list here automatically become energy property, and energy property is depreciated on a 5-year maker schedule. You take it over 5 years, and it's using a technique called double declining. So it's actually a bigger deduction in the beginning and smaller as you go forward. And so the ability to depreciate something faster, it's all based on the time value of money, and we'll talk about that on the next slide. But you always want to depreciate something faster. So for example, if you do a ground source heat pump project, that's 5-year makers. You get to depreciate it over 5 years. If you do an air source heat pump project, that's 39-year property. It takes 1/39th a year for 39 years. Just the difference between 39-year and 5-year, tremendous difference in value, time value, by being able to accelerate. So there's definitely an advantage to doing ground source over air source. And maybe you need that tax credit to help pay for all the drilling costs and things like that air source obviously wouldn't need. There are some other ways. So once you're 5-year property, you qualify for bonus depreciation. Bonus depreciation works for anything that is 20-year property or less. And so bonus depreciation, when you're 5-year in 2022, you can expense the entire project instead of depreciating you even over the 5 years. In 2023, that drops down to 80% bonus. So you only get to expense 80% of the project. And that in 2024, it goes to 60 and then 40, then 20, and then 0. But we think Congress will eventually upgrade that. So anytime you can take a technology and move it from 39-year property, which is typical building property, and move it down to an expense or some shorter depreciation, there's tremendous value in that. And this slide here kind of shows you what that value is. So if I had a $39,000 project, I'd depreciate it $1,000 a year for 39 years. The value of that at a 4% discount rate would be $6,800. With an 8% discount rate, we do have quite high inflation now, would be worth $4,158 in today's dollars. So you lose a lot of value by spreading things out over 39 years. If you can just be called energy property, the value almost doubles and nearly triples compared to the 8-year with this 12,000. And then if you can expense it, it definitely doubles and definitely triples just by the mere being able to expense. So anytime you can accelerate the depreciation of something, it's valuable. And what you'll see here is this was kind of a bridge. The tax credits are all 5-year property. 179D that I'm about to talk about is another way to accelerate the depreciation, move something to an immediate tax deduction. And so you're getting this value down here as opposed to these values over here, doubling, if not tripling, the value of depreciation. So how many of you have heard of 179D before? Anybody? Okay, I see. So it is a tax deduction in lieu of depreciation for commercial clients. It incentivizes lighting, HVAC, and building envelope projects. The deduction depends on how efficient your building is. It's available for new construction. It's also available for retrofits. And for commercial buildings, you can actually go back and get that incentive all the way back to 1/1/2006. There's a unique part of the legislation that if you're a designer of government projects, and you'll see in 2023, it's actually a designer of some other technologies as well. But if you're a designer in government projects, historically, you as the architect, engineer, ESCO, design and build firm, system designer, you could get that tax deduction on your tax return. Tremendously valuable for the designers of government buildings from between 2006 and 2022. And then starting in 2023, it's designers of tax-exempt not-for-profit buildings, and it's also designers of Indian tribal buildings. So tremendously valuable for the designers. Now, designers can't go back all the way to 2006. They can only go back for the last 3 years. That's their amendment window. This is our specialty. We've done this at, in 16,000 buildings across the country. You can't see Alaska and Hawaii, but we've done projects in Alaska and Hawaii as well. So what are the big changes that the Inflation Reduction Act did to 179D? First of all, these changes go in effect for placed in service in 2023. So this is not for things placed in service in 2022. It's only for projects placed in service in 2023. So the first one I've already mentioned, designers can now get, designers are the only party that can get the deduction for government, not-for-profit, and Indian tribal. So those entities, the only party that can get the deduction is the designer of those projects to get that tax deduction. The deduction level has changed. It used to be 60 cents for each measure up to $1.80. They increased it by inflation up to $1.88. But starting in 2023, the deduction actually drops. It goes down to 50 cents to $1. And then prevailing wage and apprenticeship come in again. If you want a bigger deduction, it has to be installed using prevailing wage and apprenticeship, and that multiplies it by 5, bringing it up to $2.50 to $5. So the deduction is now 50 cents to $1, but if you meet prevailing wage and apprenticeship, you get $2.50 to $5. Much bigger at the $5 level. That's much bigger than $1.88 for sure. They did change some things. You used to be able to qualify for lighting separate from HVAC, separate from envelope. Now you can't do that. It's more holistic. We have to model your building after the project. And if it's 25% better than the standard, you get the minimum deduction. If it's 50% better than the standard, you get the max. If you're anywhere in between, you're in between, and you qualify in between. Retrofits now have two ways to qualify, so they can use the traditional modeling method where you model against an ASHRAE standard, or you can use EUI, energy use intensity, and compare pre-project EUI versus post-project EUI. The difficulty there is that you won't be able to get your deduction until at least 12 months after your project is done, because it requires 12 months of utility bills in order to calculate your EUI post-project. You used to only be able to get a deduction once for the lifetime of the building. Now it re-ups every 3 years on commercial buildings and every 4 years for government and tax-exempt buildings. So if we use that $2.50 to $5 level, is there a question? At a 100,000 square foot building, that's a $250,000 deduction, could be up to a $500,000 deduction. If you turn that into a middle school, the designer gets that $500,000 deduction. The designer gets a $500,000 deduction just by designing an energy efficient middle school. Tremendous benefit for designers of government buildings, designers of tax-exempt buildings, designers of Indian tribal. Our designers of government buildings in the past, we have some that have not paid any income taxes since 2006. They've wiped out their entire taxable liability since 2006. Tremendous benefit for the designers of government, not-for-profit, and tribal land. So what do I mean by tax exempt and these categories? Government, it's all government buildings, so military bases, post offices on the state side. We do a lot of state universities. By far, our biggest category is on the city-town level, K through 12 public schools. We do a lot of those, helping designers get the tax deduction. Not-for-profits, 50% of all hospitals are not-for-profits. Starting in 2023, we think this is going to be a big category for the designers getting a benefit for their not-for-profit hospitals. Religious institutions, private schools, private universities, the designer now gets the benefit for designing energy efficiently. And then tribal, we're talking about police, fire, community centers, casinos, all those projects will now qualify the designer for a tax deduction. Back on the commercial side, the deduction is instead of depreciation. So normally you depreciate over 39 years. Now you get to expense it potentially up to $5 a square foot. You can go back. We can do projects all the way back to 1/1/2006. This works best for commercial new construction and any residential building greater than 3 stories. The reason being, commercial non-residential buildings doing retrofits, they don't need 179D. There are other techniques, qualified improvement property, bonus depreciation, repair regs, section 179. Using those techniques on commercial non-residential retrofits, they can get accelerated depreciation already. They do not need 179D. So where 179D works on the commercial side is new commercial construction and any sort of residential greater than 3 stories, new construction or renovation or retrofit. The one place it doesn't work well is when you can use QIP or bonus or repair regs or section 179, and that's commercial non-residential retrofits. If you're doing a commercial non-residential retrofit, you do not need 179D to assist you. Some important dates. We have ASHRAE 2007 to compare against all the way out to 2026. And then after that, it turns to ASHRAE 2019. The key is that ASHRAE 2007 had fluorescent lighting as its standard. So if you put in LED lighting, you're already going to be better than the ASHRAE standard. So when they turn it to 2019, it's going to get more difficult. But against 2007, lots of buildings qualify against it. And then prevailing wage and apprenticeship, it became effective 1/29/2023. So if you started your project before 1/29/23, then you're good. you automatically get the $2.50 to $5. But if you started after that, then you have to meet the prevailing wage and apprenticeship requirement. So I said I'd touch on the prevailing wage and apprenticeship requirement. There's a list of your prevailing wage. If you go to this website, www.sam.gov, and you type in your county and the type of project, it will tell you what the wage is that you need to beat to meet the prevailing wage requirement. If it doesn't, sometimes it doesn't have all the categories. If it doesn't, you have to send a wage determination request to this email address, and that request has to have all this information in it. And then theoretically, they'll send you a wage determination, which you can use to meet the prevailing wage requirement. You're going to need records, and those records have to be for your employees, your contractors, and your subcontractors' employees. Anybody installing the project needs to meet these requirements if you want the higher $2.50 to $5. You got to identify the wage determination, the laborer's classification, whether they're an apprentice or a journey worker, how many hours they worked, and the wage rate. And you got to do this on a daily basis. And the reason for that is because of the apprenticeship requirement. You need, starting 1/1/29, you need at least 12.5% of total labor hours to come from apprentices from a registered apprenticeship program. After the end of this year, you're going to need 15% of the labor hours to come from registered apprentices. And the reason you need daily information is because there's an apprentice to journey worker ratio governed by the registered apprenticeship program, and you have to meet that ratio on a daily basis, which means you need records on a daily basis. So these are the requirements for the apprenticeship program. So to model a building, you model the building, you got to use approved software. You're looking at the lighting, the HVAC, and the envelope specs. We're going to need specs. Oftentimes, we're going to need drawings to do that. The overall building's use has to be 25% better, maximizing out at 50% better. The retrofit method is, using EUI. Currently, Portfolio Manager calculates EUI. Energy Star's Portfolio Manager might be the way you calculate EUI, sorry. And you don't need to simulate the project. You can just do it off of utility bills and get that information. And once again, it's 25% to 50%. Starting in 2023, no more individual measures. We can't qualify lighting alone, can't qualify HVAC alone, we can't qualify envelope alone. To get this deduction, you need two things. You need a project in the lighting, HVAC, or envelope realm, and you need to beat a standard, whether that's the retrofit standard, ASHRAE 2007, all the way out to 2026, or after 2027 and beyond, ASHRAE 2019. You got to have both those things. You need a project and you need to beat a standard. This is the list of HVAC technologies that tend to qualify. And you'll notice the three technologies where you can double dip. You can get the credit and you can also qualify for 179D. And for those government projects, for example, the government can get the tax credit and the designer will get the 179D deduction for installing these technologies. We're going to need a lot of data. So we're going to need comm checks. We're going to need as-built architectural, electrical, mechanical, plumbing drawing sets. We're going to need lighting line by lines, mechanical equipment schedules. If you don't have the drawings, we're going to need window to wall ratio, U values of windows, R values of roof and wall. We have to run an energy simulation model. So we're going to need information to do that to prove that we get the 25% to 50%. If you're using that alternative retrofit, then we need energy bills. We need 24 months of bills before the project, 12 months of bills after the project, and all of the bills during the project for all utilities, even if you didn't touch a particular utility. As I mentioned before, 179D works best for government and tax-exempt buildings and residential buildings, and then only commercial new construction. So these three categories is where 179D works best. The one place it doesn't work well is commercial non-residential retrofits. Commercial non-residential retrofits have other ways to accelerate the depreciation. So that's my presentation. If you have any questions, I'll gladly stick around and answer any questions. If you want copies of the slides, just shoot me an email and I gladly send you copies of the slides. And so I'll gladly open it to questions if you have them.
Questions. This is a lot of information.
Yeah, it's like a fire hose, unfortunately.
Yeah, it is. But it's good. Good. Questions, Bob? You look like you got a question on your mind.
Yeah, it might be too stupid a question, but if the developer, I mean, if the designer gets all the benefit from this, what's the point if I'm a developer? How would I benefit?
Well, commercial clients, the commercial client gets the benefit. So if you're a developer, building a building, you're a commercial building owner, you're the only party to get the benefit. If you're a government building or a not-for-profit, then the only party that can get it is the designer. So for your developers doing commercial buildings, they do get that the 179D tax deduction. They get it directly.
Thank you. I got a question. We talked about residential, a right good fit in different categories that fit. One would think residential is brick and mortars and facilities. But not everybody lives in a house on a piece of land. Some people live in like a mobile facility, small houses, that type of thing. What's the application to non-brick and mortar residents?
So let me just back up for 1 second. Today's presentation was only related to, and actually I'll stop the share part. Yeah. Today's presentation was only related to businesses, meaning, so for when I say residential, I'm talking about a landlord-tenant situation, a landlord business. And those have to be 3 stories or above, or the tax credits don't have that requirement, but it's a landlord owning a building that they're renting out. Talking about commercial buildings, talking about government buildings and not-for-profit buildings. The category I didn't talk about is the one that you're talking about, even not just the homes that you're talking about, but even a single family home, for example, your own, or a condo or a co-op. I'm not talking about those. Those have different incentives completely. I'm not an expert on them, but there are incentives for things like solar and things like, for example, somebody asked me a question about, oh, I want to put an air source heat pump into my own personal home. Is there a credit for that? And, I try not to be an expert because I don't want a whole bunch of residences call me about things, but I did happen to look this up because I was considering the same thing. And so there is a $600 credit, for example. It's a 30% credit up to $600 for putting in an air source heat pump, for example, into your own personal home. So there are a bunch of residential type, putting solar panels on your home, putting solar panels, air source heat pumps, things like that. There are incentives for that and there are credits for that, but this presentation didn't touch on them. And I really do try not to find out about them because then people ask me questions about them.
Thank you for your answer.
All right.
Any other questions?
All righty.
How do you make your money?
So we assist building owners and designers get the 179D tax deduction. So we create all the paperwork in order to take that tax deduction. We believe that when governments and not-for-profits start taking those tax credits that I talked about in the beginning, that those entities are going to need assistance as well. And so we hypothesize that we'll also have a business creating all the paperwork that allows governments and not-for-profits take that laundry list of tax credits.
I was kind of curious of that myself. I didn't know what his position was to do that, but that's good. All right. Anything else?
So I'm going to stop the recording.